Good morning, ladies and gentlemen. Welcome to the Experian Quarterly Business Credit Review for Q3 2022. My name is Gary Stockton. I work here in marketing for Experian. And before we get started, I just want to cover a few housekeeping items. If you would like to follow along, we've dropped a PDF of the slides in the handouts area. We'll also make a link of the slides available in the follow-up email. And if you have not yet received your copy of the latest report, you can download it at bit.ly/Q322MSR. That's the latest report. It just released just a matter of days ago. So today's webinar, we're going to be discussing key findings in the Experian and Oxford Economics Main Street report for Q3 2022. Today's talk will be presented by Brody Oldham, Vice President of Commercial Data Science for Experian, and Ryan Sweet, the US Chief Economist for Oxford Economics. Welcome, Ryan. Brody leads a team made up of statistical consultants, scientists, modelers, and engineers with diverse skills who provide clients with leading-edge analytics-driven information tools, services, and data visualizations of actionable insights. And he writes and speaks on behalf of Experian about trends in credit market. Ryan Sweet is the chief US economist at Oxford Economics. He's responsible for forecasting and assessing the US macroeconomic outlook and how it will influence monetary policy and the financial markets. Ryan is among the most accurate high-frequency forecasters of the US economy, according to MarketWatch and Bloomberg LP. Prior to joining Oxford Economics, Ryan led real-time economics at Moody's Analytics and was a member of the US macroeconomics team. Please send us your questions. We want to make this an interactive section. It's going to be a lot of really great insights on small business credit trends and a macroeconomic outlook. So take this opportunity to engage the panel of experts while you have them here. You can do that by clicking on the question icon in your GoToWebinar tool palette there. And we'll try and leave some time at the end of the session today for those. And now I would like to turn things over to Mr. Ryan Sweet. Ryan.
So a few things to that, and again, just like Gary mentioned, we want to make this interactive. So if you have any questions, I'm sure there's a lot of questions about the state of the U.S. economy, where we're headed. But a few takeaways. We have a recession in our baseline forecast for 2023. And the catalyst of the recession is really, really important because that's going to determine the severity and the depth of the economic downturn. And this recession is going to be attributed to a policy mistake. The Fed's going to raise interest rates too aggressively. They're going to choke off demand, and that's going to cause a recession because the Fed's trying to address two things, or basically one thing. They're trying to reduce inflation, and inflation in the US is still very, very elevated, but a lot of our inflation problems that we'll get into in a little bit is attributed to supply issues. It's supply shocks. It's Russia's invasion of Ukraine, the lack of housing that we've built over affordable housing that we've built over the last couple of years, and supply chains stress. Those are issues that the Fed can't address unless Fed Chair Powell starts drilling oil and starts driving container ships or builds homes. The Fed can't address those. And you can see among the consensus on this slide is among professional forecasters, which Oxford Economics participates in. This is the most well-anticipated recession ever. So this is just showing you the odds of a recession in the next, in the near term, and odds are really, really high. Economists were very hesitant to put recessions into our baseline forecast unless we're very comfortable that it's going to actually come to fruition. And it seems that more and more economists are baking a recession in to their baseline forecast for next year. So if you go to the next slide, Gary, you can see that it's not just economists that are pessimistic, it's businesses, it's consumers, it's you and I. A lot of pessimism around the economy is starting to grow. So what this chart is showing you is the net percent of small businesses, and this comes from the NFIB Small Businesses Survey, expecting the blue line is expecting the economy to improve. The red line is the NFIB, just the overall business confidence, in general. one word of caution, and this shouldn't be too surprising, is that the blue line is influenced by politics, in the sense that when you have a Republican in office, businesses, small businesses in particular, are more optimistic than when you have a Democrat in office. And that's related to just policy. And it's a political bias that, generally Republicans are more small business favored. They like to cut taxes and things like that. So I don't think overall sentiment is as depressed as it appears on this chart. But in general, businesses, even abstracting from the potential political bias, is pretty downbeat. You look at consumer sentiment, they're downbeat as well. I think there's just a lot of angst about the strength of the economy going forward. And this is something to keep a close eye on. In general, I don't pay a lot of attention to consumer or business confidence unless we're at an inflection point, because that's the only time that it matters. Because in general, recessions are a loss of faith, and when businesses, consumers, or investors lose faith, then that's when you cause an economic downturn. We're losing faith now, but it seems that we're more likely going to talk ourselves into a recession because of a policy mistake than any significant shock that has caused significant recessions in the past. So think about each of the last two recessions. We don't want recency bias. This recession coming up is not going to be like the pandemic one. It's not going to be like the great financial crisis. It's going to be more like your garden variety downturn that we experienced in the early 2000s or in the early 1990s. Is nothing going to be like each of the last two recessions. One reason why the recession is going to be mild is there's no glaring imbalances in the economy. So if you look at household balance sheets, they're in very, very good shape. A lot of questions about the level of debt, but the level of debt doesn't matter. It's debt service burdens or financial obligations. And if you look at debt service ratios or financial obligations ratios, they're the lowest they've been since the 1980s. So an example I always use when I get pushed back about the level of debt is think about this. Do you know the amount that you own on your or that's outstanding on your house, on your mortgage? You probably don't, but you know exactly, probably down to the penny, your monthly mortgage payment. All right, so that's why the debt obligations, that's what matters. It's not the level of debt. And the reason why the level of debt or financial obligations are really, really low is because of the strength of the labor market. As you can see in this chart here, this is showing you the monthly job growth, and the blue bars are just the monthly change, and the red line is the 3-month moving average. So look at the red line. That's the one that matters. That's the trend. And you can see trend job growth is running north of 200,000. Pre-pandemic, when we had these conversations in the past, anything north of 200, we would be celebrating. So post-pandemic, the job market is just red hot. We're doing really, really well. Unemployment rate is still south of 4%. So it's very, very difficult to be pessimistic about the economy when you have a south of 4% unemployment rate. The issue is that the job market's too high. The Fed is really trying to slow the labor market. So the path to a soft landing really goes through the labor market, not necessarily inflation. You can see that the unemployment rate here is still historically low. And this is probably frustrating the Fed. The Fed, currently we have an unemployment rate of 3.7% as of November. The recent low was 3.5%. The Fed probably wants the unemployment rate to be closer to 4%. And to get that, they need to slow the economy, meaning that, the amount of things that we're producing or consuming needs to be below the economy's potential, which is roughly 2%. So they want the economy growing, 1%, a little bit less than that, to gradually nudge the unemployment rate higher. The issue is that when the unemployment starts to rise, historically, that's a recipe for a recession. And the rationale behind that is, it gets back to the collective psyche. When unemployment goes up, I start to see my neighbors getting laid off. My friends, family get laid off. I get worried about my job, and therefore I cut back on spending, and that affects a lot of people. And then, when people react, that leads to more layoffs. That leads to more people reacting to an increase in unemployment rate. So historically, the unemployment rate is a very, very good coincident indicator of where we are in the business cycle. Anytime it's risen by 50 basis points on a year-over-year basis. And as an economist, I'm going to throw probably a ton of numbers at you, and I apologize. But when it rises by 50 basis points year over year, that's game over. We've never experienced an increase in the unemployment rate by that magnitude without a recession. And why the Fed is kind of forecasting a recession is if you look at their summary of economic projections, they have a 60 basis point increase between the end of this year and the end of next year. So essentially, the Fed's facing Hobson's choice, the worst of two outcomes: a mild recession now, or the potential for stagflation down the road. And facing that, stagflation is a central bank's worst nightmare. Therefore, I think the Fed is opting for, let's push the economy, not on purpose, they're not doing this intentionally, but if they had to choose between stagflation or a mild recession, they would choose a mild recession now. And that's why they're forecasting a mild increase in the unemployment rate, enough to push the economy into a mild downturn over the next 12, 18 months. This is my favorite slide. This will tell us whether or not we're on the path to a soft landing. And a soft landing is where the Fed can reduce inflation and put inflation back down to their 2% target without pushing the economy into a recession. And to gauge their progress, you can look at the beverage curve. And the beverage curve is for the holidays. This is a fantastic topic to bring up. You will sound like the most intelligent person in the room when you bring up the beverage curve at the holiday dinner. It's just showing you, this chart is showing you the relationship between the unemployment rate, which is on the x-axis, and the job openings rate, which is on the y-axis. So the Fed wants the job openings rate, in other words, a proxy for labor demand, to come straight down. So they want to reduce labor demand without pushing the unemployment rate higher. And that gets back to the point I made earlier, is that when the unemployment rate increases, that generally leads to a recession because people get nervous about their jobs, they cut back on spending, and then you get this cycle that just feeds into one another. So you can see in October, we're moving straight down, which is a good sign, but at least historically, the Fed's not been able to pull this off, where you get a straight down or a vertical downward shift in the beverage curve, meaning that they reduce labor demand. Those that get laid off or aren't hired are able to find work very, very quickly, and that prevents the unemployment rate from rising. That typically doesn't happen. That big outward shift, I'm sure many of you are wondering, what the hell is that big outward shift? That was the pandemic. So that's when the economy shut down, labor demand crashed, unemployment spiked, and we got a big outward shift in the beverage curve. So this tells us where we are in the business cycle, but also I think this is a very, very useful gauge of whether or not we're on the path towards a soft landing, which I think in our view, in Oxford view, is very narrow. The Fed can pull it off. I'm hoping they pull it off because I'm not rooting for a recession, but the odds that they can pull it off is very, very narrow, in the sense that, at least historically, they haven't been able to reduce labor demand, which is the demand side of the economy, without pushing the unemployment rate higher. And that's a recipe for a recession. So going back to the strength of the labor market and going to Fed policy, there's a lot of focus on nominal wage growth. And if you look at different measures of wages, I would push back against looking at average hourly earnings, which is the dotted orange line on the left-hand side. The best measure of wages is the blue line. It's the employment cost index. And you can see with the tight labor market, wages are rising, and that raises a concern for the Fed in the sense that we're going to get some demand pull inflation, in the sense that you and I are going to start getting, Gary's getting big pay raises, month after month. He's going to go out and start spending a lot of money. He's going to start pulling prices higher. That's sticky inflation. So far, if you break down or decompose inflation, more than half of our problems are supply side issues, and I'll show you that in a little bit. Demand pull inflation, meaning that you and I are pulling inflation higher, that's a small portion of the inflation issues. If you look at the causal relationship between inflation and wages, it runs from inflation causing changes in inflation or in wages, meaning that Gary's driving by the gas station, going to the grocery store. He's saying higher prices for gasoline, bread, eggs, and he's demanding a higher wage. If you look on the other side, on the right-hand side, this is the small businesses. This is where small businesses are feeling the cost pressures. It's really squeezing their profit margins. You can see that the net percent of small business planning to raise employment, but also the net percent of businesses that are not able to fill a position right now. So basically, small businesses, you guys have a boatload of open positions. It's hard to fill them. And to fill them, you need to, on the left-hand side, pay higher wages. And that squeezes profit margins, and that is a cost pressure. The sticking point for the economy, and one reason why I'm concerned, is when you have very tight labor markets, when you have rising wages, when you have high inflation, that's cutting into real disposable income, and the consumer's purchasing power is starting to deteriorate. And you can see that on the left-hand side. So the key, ignore the red line. I included it just, to appease anyone that wanted to look at nominal disposable income. The key for real consumer spending, so how aggressive consumers are going to spend going forward, is the blue line. And that's real disposable income, and that's adjusted for inflation. And you can see it's declining, and that's attributed to high inflation, and that's going to be very, very problematic. And that's one reason why Oxford Economics, we have a recession in our baseline forecast. One question.
Sure.
What do you think about recession?
I think it's good to take a neutral position. I think there are signs there, definitely, Ryan, that point us toward a recession coming, and certainly a slowdown. And like you said, there's opportunity for that improvement to be there, for them to have a soft landing, but there's a lot of signals that go the other way as well. So it's one of those, looking at what could happen, we can just really say what we're seeing. I think it's a good way to go.
Sorry, Brody and Gary, I didn't mean to put you on the hot spot.
No,
it's the opposite. I got 3 little kids, and they put me on the hot spot all the time. And I'm going to pass it over to Brody soon, but here's an example. So this weekend we went to a train ride with Santa, and then the next day we went with dinner with Santa. And my middle son looks at me and he goes, "That's a fake Santa." I'm like, "What do you mean that's a fake Santa?" And he's like, "That's not the same Santa I saw yesterday." So it's kind of like a recession call. You can see different things, but if you look at the slide on the right-hand side here, U.S. Real consumer spending, why we think a slowdown in the economy is inevitable is that we're going to get a shift from goods spending, which is stuff. We bought a lot of stuff during the pandemic, and we're going to shift towards services. And this is key for a couple things. First, you're going to see retail sales be very, very weak, and that's not alarming, because that's just us buying less stuff online and moving towards going to ball games, going to barbershops, going to restaurants again, movie theaters. So I took my kids to a movie theater for the first time, I think probably in their entire lifetime. But we're going to see the mix of spending start to shift back, and you can kind of use these dotted lines to show where the pre-pandemic trend would have been and where we are relative to that. And you can see for the red line, that's durable goods, meaning stuff. We're well above that dotted line. So we got to get back down below that to normalize, and services spending is going to pick back up. And we need a lot of goods disinflation, meaning that we got to buy less things online to put downward pressure on inflation to offset the inflation that we're going to get from services, because we're going to be buying more and more experiences. And you can kind of see where the breakdown of inflation is currently occurring. So core services, that excludes food and energy. You can see that's the bulk of our issues right now. Core goods prices, that was a big issue in the last couple of years, and that's supply chain issues. But core services, if you break that down and go even more, I don't want to get too into the weeds, but a lot of that is shelter. That's rents, that's owner's equivalent, and essentially owner equivalent rent is what would I pay to rent my house out. And a lot of that is attributed to supply shocks because we didn't build enough affordable homes. But the good news on core services is that rental inflation shows signs of ebbing, at least by mid next year, because if you look at market-based measures of rents, they're rolling over now. And that takes about 12 months or 6 to 12 months to show up in the CPI data. So there's going to be relief on the rent front. Energy prices, as long as they don't rise, food prices should come down, because the biggest cost of or input cost of food is getting it from farm to table, farm to restaurant, or farm to the grocery store. So those price issues start to come down soon. And we're seeing relief at the pump already. So in our view, with the economy slowing, entering a recession, that a recession, at least historically, has been very, very disinflationary, and that's going to provide some relief on the front, on the inflation front.
With that, I think we're going to hand things off to Mr. Brody Oldham, right?
All right. Thanks, Gary. Thanks, Ryan. Some good points made, definitely toward the way that we're looking at macroeconomic trends coming forward. Certainly that consumers are out there still spending has really created some upward pressure on those inflationary numbers like Ryan spoke to. And so we'll look at how we are translating what we're seeing in the macro environment to what we're seeing for small businesses in the US. And the way that we do that is we're going to look at our small business data here at Experian. And it's consortium-based data. We have several different data sets here at Experian that we use that contain commercial information, transaction data, delinquency data, all put together in one space. We're able to bring together also blended views and trends that will allow us to see how the consumer is performing as well as a small business. And really within the US, you're going to see a great correlation between the two. And we're going to talk about the way that those two different trends are impacting each other. And Ryan touched on it just a bit toward the beginning of the call. And so we're going to get and dig into how it's impacting small businesses specifically in the second half of our time today. So the thing that I like to do first is look at our consumer trends here at Experian. And one of the things that you'll notice as we look at those trends is that we'll see that consumers are still performing pretty well. So as we look at the consumer trends, what you'll see are some of the big facilities that consumers are using to leverage some of the purchases that they have. You're going to see the big lines coming down for mortgage. So as home ownership becomes more and more expensive, and Ryan touched on that a little bit earlier, interest rates on those mortgages, certainly for a 30-year fixed, have gone up pretty significantly. You'll see a pullback in those that are being originated there, and that's that pink line right in the middle. You can definitely see it. Auto loans still up, still kicking along as those cars fill the lots. Consumers are still out there buying cars and replacing those that they've been holding on to a little bit too long. Unsecured debt, certainly from a credit card perspective, continues to rise, and we'll see that these are some of the facilities that small business owners will use to cover some of the costs of their business purchases as they go forward. Looking at comparing what they can use from a small business perspective over to that which they use in their personal credit profile. And of course, here at Experian, we educate small business owners to really put a lot of focus on their small business credit, because it really brings up both scores, keeps you healthy on both sides. And so a small business owner leaning in that direction is definitely going to help the market and the survivability of small businesses as we go into this downturn period in the next 12 months. So you'll also see delinquency rates are rising. Now they've crossed over that line. If you're watching any media, you'll see our numbers quoted out there, crossing the line of where we were pre-pandemic, certainly from a consumer's perspective. You'll see all products are really trending upwards as far as delinquency rates. Mortgage, purple line along the bottom, staying pretty flat. That's because what's being originated now is really, I would say, low risk type of paper. And so those are performing a lot better. And people don't want to lose their homes during this market where prices are really still pretty high, even though they're coming down just a little bit. So what you'll see is as we look at the small business trends that we're seeing, both term type of loans, these are our installment type of loans that you'll see coming out from our small business lenders. You'll see that the trend in the blue bars are continuing to trend upwards. And that's a good sign. That means that credit market is still open. We're seeing that small businesses are still looking for an opportunity to pick up some of these loans. Now, they may not, one of the reasons why we're going to see some heightened activity here for small businesses is that home values, the equity that they have in their home is starting to trend off. They're losing a little bit of that equity, still a lot there. But it costs them a lot as far as the interest rate on the loans that they're trying to pick up. To pull cash out of those properties, a little more expensive than they're used to. So they're relying a little bit more heavily on some of the small business products that are being offered. And so we should continue to see good activity from a small business perspective on installment type loans. What you'll see down in the bottom right corner are credit cards, so unsecured products. You'll see that trend also moving in the upward direction. And certainly the blue bars show you that originations are picking back up. And, you know, as cash flows begin to slow, what you're going to see is these originations remain strong as long as the credit markets remain open for small business lending as we get into next year. Now, what you are going to notice here are the purple lines, and the purple lines are the credit line that's being offered to small businesses, and that's been precipitously dropping over the past year, 2 years. And the reason why you'll see that is a trend that we've seen in small business applications that are coming in, new businesses to the market. And when we look out there into what we see on our Experian portfolio within our credit data, what we saw at the beginning of this year was almost 40% of the businesses on our book were less than a year old. Now, as we've transitioned through to 2022, what we've seen is that percentage begin to decrease, and that's as you see some of those new businesses age into over 12 months and move into the standard market timing for originations and underwriting for some of our larger lenders up into the 24-month range, 12 and 24. That's where they generally see it. And businesses have about one card, you know, as they start off and emerge. So a lot of businesses out there, about 27% currently of our book right now are brand new businesses under a year old. Well, you're not going to give a credit line that's very high to those businesses. So as we see more and more of those businesses seek some credit, you'll see the credit lines continue to drop and move and settle into an area where underwriting risk is pretty consistent. So when we think about underwriting, one of the things that you'll be interested in is, you know, if we're looking at a recessionary period in the next year, are lenders starting to tighten, or are they thinking about tightening? And what I would say is they've been thinking about tightening for a little bit more than a year now. Now, that thinking about tightening and actually tightening are two different things. I think the levers are being created, some different activities. So looking at the way that you can lower a credit line, reduce some of your exposure as a lender, some of those activities are taking place right now as the goals and targets of the credit market is still to grow. You still see good activity, strong consumer spend performance. We still see cash flows really at a heightened level for small businesses. And so that opportunity to really tighten down credit isn't there because folks are still paying their bills at a very high rate and small businesses are still paying on time at a very high rate. So those credit markets should continue to stay open. But the trend here is important to watch because you'll see that that thought process is there And certainly those levers are being prepared should delinquencies increase at a heightened rate. So what I want to show you on the next slide is utilization. So as we look at small business performance and we think about the credits that's out there, I talked about a small business owner having between 1 and 2 credit cards. And this is looking at credit card utilization. If you have 1 or 2 cards, think about how many cards you have in your personal wallet. You may have 5 or 6 across your family. You may even have more. Well, utilization, you can spread that from a consumer's perspective over many different cards. While what we'll see for small businesses within the US is they may have 1 or 2, and certainly with a high percentage of emerging new businesses less than a year old, they might just have 1 card. And so that will push the utilization curve upwards, and we'll look at utilization rates crossing over into pre-pandemic levels very soon. And that's certainly leveraging more and more as you see small businesses continue to be in growth mode because consumers are continuing to spend. So spending is great, utilization increases. What's the downside here as we look in a growth market where you have a lot of new businesses there? One of the things that you're concerned about is what's the risk, what's the exposure that I have as I'm servicing some of these small businesses. What you're going to see is a regional view on the left. This regional view looks at delinquency rates for slow pay. This means if you're 1 to 30 days late, maybe you're having a little cash flow problem, maybe you're not getting your payments in quite as quickly as you'd like to, you're holding back a little bit, making some choices. That creates some of these slow pay delays. Now, when you look at the trend, you're going to see that yellow line right on top toward our current section or timing, and that yellow line represents the South. Now in the South, if you go to the Census Bureau and you look at where all the new businesses are forming, it's forming in the South. So a significant percentage, doubling a lot of the other regions in the number of new business applications that are being submitted. Also about, if we look at the SBA, about 60% of those are surviving. That's a lot different than pre-pandemic. Pre-pandemic was about 40%. But since we've had so much stimulus and opportunity and programs for small businesses to get additional funding during emergency time periods, we've seen small business survival continue to improve. But that means that you'll see a lot more businesses out there, a lot more small businesses coming into the market, being fairly strong. But what we're seeing is that a lot of those emerging businesses having a little bit of difficulty right at the beginning as they get started. And that's why we're seeing the South kind of a little bit higher than the rest of the regions. Now, when you look at our delinquency trends overall, and we look at rolling delinquencies, and this middle chart looks at really at a cascading form, we want to see the smallest delinquency, so 1 to 30 up at the top, going down to 30 to 60, 60 to 90, and so forth. We want to see that order. The reason why we want to see that order is as we keep it in that order, we don't want to see 90 go above the 30. What that'll mean when we see that inversion is that we're having more and more accounts roll into deeper delinquency. And so we don't want to see that. That's what we'll see as we get closer to a recessionary period. We're seeing some of that inversion in our installment type of loans. So this is unsecured that you're looking at here, but installment term loans, we're seeing a little bit of the inversion between 30 and 60 days, meaning some are rolling into more of a delinquency, but still significantly low and really at historical lows. Now, when we look at industries, you'll see pretty stable across industries. Public administration, you're going to see some of that, really looking at what's coming, what's happening within local regions can impact this, waiting for Build Back Better funding to come through for some of the projects that have been outstanding, maybe overextending a little bit in public administration and some of the costs. So we're seeing some spikes and irregularity there. We continue to watch it. I think there'll be other areas that really you'll want to focus on as we go forward and looking from a lending perspective. So when we think from a portfolio perspective, what you have on your book, one of the things that I always like to look at is what's happening year over year. Does my portfolio look to, are there any types of industries that are creating any potential exposure for my portfolio? What do I need to focus on if I'm doing pre-treatment strategies? What should I look out for? When we look at the Experian portfolio, and here we're looking across all industries, we're looking in the card type of products, what you'll see are construction, continuing to have some challenges. We're going to see this get a little bit deeper even as we get into the first of the year, and that's because as we see home builds start to slow even more than they have now. Home prices are really high. Not as many people can afford those new builds as before. Commodity prices have been kind of fluctuating up and down. You'll see construction looking at what is the opportunity for new builds in next year. There may be some continued delinquency heightening here in the next 3 to 6 months, certainly in that segment. Mining is always challenged. We go back and forth. Ryan mentioned a little bit more. Well, what if we drilled a little bit more? What if we did a little bit more of this and this across the US? And that's certainly something that can impact the mining industry. Certainly some regulatory pressure there that's causing some challenges for companies within, for mining companies within that segment. So we'll continue to watch that as well. But global pressures could again reset this in the next 3 to 6 months, depending on some of the changes that we may see. OPEC's held pretty strong, but we'll see in the next 3 to 6 months if anything changes, if we see any fluctuation, certainly across macro economies. So bankruptcies, even though we're seeing delinquency rates go up, we've seen bankruptcies be really a falling factor over the past 2 years or so. Not as many as before, a lot more stimulus there. Businesses are being held up really beyond the time frame that they probably should have from a health perspective, but that stimulus is starting to run out. We're seeing some of those zombie businesses that have been held on by a thread for a couple years here start to fail. We'll see some of the tech companies have a little more challenge as the market resets, the industries reset. So we'll see some bankruptcies pick up a little bit more, probably, but not at a rate where we'll be back up to pre-pandemic levels, probably for another 6 to 12 months at least, where we see that type of acceleration in this type, because that follows. There's a lot of time in there in building in that bankruptcy status and to go through the process itself. So we should see that trend slowly pick back up a little bit here in the next 3 to 6 months. So here's one of the ones that we touched on a little bit earlier when we were talking about what's the difference between consumer and commercial sentiment. And this is a good measure that we look at just to give a view of what you are seeing out there in the market with all this consumer spend. So even with consumers with full pockets, you'll see the blue line here trailing off. That says consumer sentiment. They have full pockets. Their delinquency rates are still historically low. They still feel bad about what's happening out there in the market. Inflation is really high. And so that has been taking this trend line downwards, and it's been going downwards since the pandemic. What you see here is that the small business up in pink has been very stable. Why? Well, it's been stable because stimulus entered in with PPP, with different types of subsidy programs into the market. We're going to see the SBA roll out some disaster programs this next year that'll be no interest type of term loans into the market for those businesses impacted by a natural disaster. That's going to keep up small business performance, cash flows, even as consumers start to slow spend. Now, if they really slow down spending and consumers begin to pull back after the holiday season, we'll see this small business performance or the sentiment begin to drop off and align more with the consumer sentiment. Now, in previous recessions, that's really been the case. We've seen them follow hand in hand as the consumer begins to feel bad about the economy and about the marketplace. They'll pull back spending, cash flows for small businesses would dry up, and you would see consumer and commercial stimulus really almost on top of each other, with small business a little bit lagging, but following in that same trend. This recession has been a little bit different post-pandemic, certainly a little bit different, but the recession that it has a high potential in the next year can certainly bring those back together. So we'll be watching that as we get into the next year. So one of these, now this was very similar to something that Ryan presented, but I wanted to show you maybe in a little different way. And we're looking at spend versus income. And the blue line is your spend, your consumer spend, and you can see that big dip during the recessionary period during pandemic. Coming back up, consumer spending and what we like to call revenge spending. They're tired of sitting in their house and not buying what they want. And you know, some of the folks that I know that have earned their first job, they're like, you know, I worked really hard today. I think I'm gonna go buy myself something. I may not have the money for it, but I'm gonna go buy myself and reward myself, give myself a good pat on the back. And so spending has really been very strong for consumers. Now, what we've seen is inflation eat away at wage growth and income, and you'll see that pink line has really dropped down below where we were pre-pandemic. So that means wages are less than they were pre-pandemic, but spending is really much greater. And that means that there is an endpoint to this. This isn't a sustainable trend when your spending is above certainly your income. And we'll see that trend relate into the savings rate. So the savings rate down around 3%, even lower, as we look into the future here, as consumers continue to spend into that savings that they had built up during the pandemic. These are decade lows for savings rates. We've already seen low income segments already start to peel off, have higher delinquency rates. Subprime is definitely gonna feel some impact here in the next few months, even more than they're already feeling. Certainly that lowest income segment is going to feel it the worst as we get started off into the new year. So we'll look at that. You think about holiday shopping, you haven't gotten your bill yet, you're spending like you still have a ton in the bank, but you're not saving as much anymore. What's going to happen when you get your bill after the new year? So I wanted to take us into what are some of the holiday expectations. So when we look at this season that's coming up, we've had really good spend, certainly through Thanksgiving and Black Friday. If you look behind me, I have a couple boxes that have been coming in, and I've been hiding up in my office for some Christmas presents and things from Black Friday. Black Friday sales are actually moving along pretty good, a little lower than expectation, but still above last year. And the expectation is that overall retail sales are going to be up about 3%, close to that, higher than they were last year. So that's still pretty good, even in the face of a potential recession in the next year, when people are generally tightening their belts. We see consumers still out spending at a heightened rate. And what you'll see here is department stores, again, looking at sales across these, looking at the number of accounts that are delinquent. You still see it pretty stable across department stores. And we looked at the numbers of the Experian portfolio, and we look at these types of businesses. We're seeing, again, delinquency rates pretty stable, still pre-pandemic levels or below, but right at that edge point where they're going to pick back up. We're continuing to see consumer spend come in. If that consumer spend continues through the holidays, then we should see a good retail season, certainly to end out 2022. Now, 2023 will bring something a little bit different, where you'll see some continued inflation. You'll see consumers still wanting to spend more, but beginning to pull back a bit. And so it'll be a little bit more challenging as we look into the next year. Now, some of these businesses that have, I've been waiting probably like you for all these sales to come through, and a lot of high inventories for some of these retailers and wholesalers sitting in warehouses and waiting to come out to be presented to us as consumers. Some businesses have decided to hold on to some of that inventory and not sell it off as deep of a discount as was expected. And I was certainly out there looking for some deeper discounts this year, and we're seeing a lot more of those offers come through the mail, but not at the height that the market really expected, not those deep discounts that were expected really across retail in general. So that hold on to inventory, being able to sell it as we go into the next year, maybe not order as much. And we've seen factory orders certainly depressed from where they were a year ago. So we'll certainly see a bit of a slowdown here as we get into the next year, and consumers will start to feel that come to them. So when we think about what you're doing as a lender, or what the lending market is doing in general, if that's something that you're interested in, here's some of the levers that are really being prepared as we go forward. We see some of our partners continuing to market. Consumers are spending. We're going to continue to market to those small businesses that are out there to continue their growth and investment phases to handle the customers that they have coming through the door, and they still are coming through the door. We look at enhanced fraud procedures. Boy, a lot of cyber activity happening out there now. And so as you look at this increase that we've seen, certainly from a US perspective, malware, different types of attacks, both here domestically and international, physical and non-physical attacks are certainly on the rise as we look across the US. There are things that are being reevaluated as well as reassessing the policies and rules that were put in place. And, you know, as you're going digital a little bit more and consumers are expecting more out of you as a provider, providing that same level of service, and even for a small business lender, providing that same level of service that they were used to. If you have 1,000 rules now in your underwriting policy, some of those can be contradictory. So we have a lot of customers looking at that and leveling those out, taking a look at how they can streamline their process a little bit more. And pre-treatment strategies is another lever that we see a lot of right now. As we see those delinquencies start to peak up above pre-pandemic levels, getting ahead of those delinquencies now to create opportunities for legacy and loyalty customers to continue, and certainly through a recessionary time period, keeping those most profitable customers healthy and whole will definitely help your business as you go forward. So when we think about wrapping up what we've looked at today and some of the macro trends that we've seen, you know, the things that I like to touch on again are that consumers are pretty strong, pretty healthy. Bank accounts still pretty healthy as we go forward. You're seeing some competition between banks and getting some of those deposits put in, so a little more competition there. The U.S. labor market is still really tight. We have a lot of job openings out there, and like Ryan said, we want to bring down some of those openings, but we want to keep unemployment still pretty low. That's what the Fed's focus is on, and then bringing down that inflation number as we go forward. So I think that gives a real opportunity. Now, consumers are still spending beyond what they're saving, so we'll see that continue to be a factor, and really an unsustainable factor as we go forward. So we'll look to how that adjusts in the next quarter. And we really see some signs, we'll be looking for signs of some more visible tightening. So as we go forward, we haven't seen that yet. We've heard folks talk about it. We've seen little parts of the market start to tighten just a little bit, but credit markets are still open. Consumers are still spending. Small businesses are still investing, looking for the future and hoping for that, as Ryan said, that soft landing that we look for in this next year. And if that happens and we're still investing and growing, a real opportunity here for the U.S. to continue its strong push forward in small business health and for consumer health in general. So Gary, why don't we open it up for a couple questions here, or if we have some that are in the chat.
Yes, definitely. Yeah, there were quite a few questions that came in today. We'll start with one for Ryan related to supply chain. And this one comes from Todd, and he asks, with China recently employing another lockdown to manage their COVID, could the additional supply chain stress further impact your forecasts, or are you already allowing for that?
It's a great question, and it's key to the inflation outlook, and it gets back to supply chains. If China keeps up with its zero COVID policy, that means the goods disinflation that we have in our forecasts may be slower to come to fruition, which means inflation is going to be higher for longer, which means the Fed's going to keep pressing on the brakes. But that also supports our forecast for a recession, because you know, the Fed's going to break something. They're going to break the economy, break inflation, or both. And most likely, they're going to break both.
Okay.
Brody's mad at me now because.
Why? I'm not mad. Yeah. It is really what you're seeing in the signals that are out there. There's a lot can go on, certainly from a global perspective, as we see, you know, Gary can look out at the bay and see the ships are moving a little bit better. But that, like you're saying, with the zero COVID policy and some of the challenges that they're having there, some civil unrest, it could disrupt a lot of the supplies that are, you know, different commodities and products that are coming out. Certainly, if you're trying to get an iPhone 14, that's going to get you as we go forward. But there's a lot of those different opportunities for global pressure to slow down that and create some challenges to bring that inflation number down from the Fed. That's, you know, a supply side. It's not demand side. Exactly. They're working on demand side at the Fed, and we're hoping that supply side kind of loosens up a bit.
And if the supply side doesn't respond, then we're going to have a problem, and the Fed's going to kill the demand side more. Hence, we would have a recession. Unless Gary gets out there and starts driving ships on the weekend, get them into the port, and unload this stuff very, very quickly, our PAL can't affect the supply side of the economy.
That's right. That's right.
We did have a question for you, Brody, that came in from Danielle. Percentage of balance for commercial card delinquency, is that percentage of minimum balance due or the total balance outstanding?
So it's a percentage of the total balance outstanding that's there, not the percentage of what's due. So it's just looking at a general balance number to say overall, what percentage of the balances that are out there are past due. And it'll, if we look at the number of accounts that you have in your wallet, if one is delinquent and one is not, then we would say that 50% of those are delinquent at this point. So it gives that percentage.
There was one about labor force for Ryan in here. A good question from Tony. Estimates for unemployment rate when retirees return to the labor force due to an increased living cost in 2023 from inflation. Have you looked at that?
We have. So one of the things we're doing at Oxford is kind of for next year and 2025, the key to the strength of the labor market comes through labor supply. So most economists, we build our models based on labor demand, and that's pretty easy to do. But it's the labor supply. And a lot of people left the labor force when the stock market was going through the roof. House prices were rising very, very quickly. But a lot of unemployed or retirees are coming back into the labor market now because they realize their nest egg wasn't as big as they anticipated, and they're seeing their house price dip a little bit. But I think overall, we're going to see the solution to labor supply issues is higher wages. And when wages are rising 5%, when the Fed wants them closer to 3.5%, you're going to pull a lot of people back in the labor force because that reservation wage or that wage that you need to give up to, you know, rather doing, you know, some time of leisure versus working, it's going up. So people are going to come back in. So I think that's one upside risk to our forecast. And that's, I think this is key to whether or not we have a recession. If people come back into the labor force in larger numbers than we're anticipating, we'll skirt a recession because people are going to spend more because wage growth is strong. So that's a key risk.
And Ryan, do you think we'll still get some inflation pressure upwards if that happens because you're adding more of that spendable dollar in there? And so the Fed's real point here is to reduce the number of openings that businesses have so that you're keeping that wage bumps that you're saying, that 5% bump where a person can say, hey, I'm going to jump to the office right across the street from me, give me a bump or I'm going to leave. You lower that ratio of those jumps, the quits versus what's open out there, and that can create a little less of that opportunity for the wage growth there to continue to have some type of spiraling effect.
I agree with you 100%. If you look at the quits rate, that does a really good job of forecasting future wage growth, particularly for the employment cost index. That's the best measure of wages. And quits are still elevated, so people are confident that they can quit their job, get another job, and that money is going to start changing hands more frequently, even though you don't see it really a lot in the velocity of money, which I think that's more, I think, a function of the aging population. So we have a lot of like talking poll things going on. You got an aging population pulling down inflation. We got a lot of people quitting their job, pushing inflation higher. So which one's going to win? I think that's the key to the outlook for the next couple of years. And whether or not, you know, it's one or the other, the Fed's going to kill inflation. And, you know, unfortunately, most likely they're going to kill the expansion.
Yep.
All right. So, Brody, how concerned are you about inflation?
I think it is something that I think will be elevated for a little while here. I don't think it'll come down as quickly as expected. I don't think it'll be a drop off like we had seen in previous. So that's my perspective, the perspective of Brody Oldham and not that of Experian. So I'll tell you that just as a quip on the side. Yeah. I think it's going to last a little bit. So I don't think it'll come down as quick as expectations in the next year.
Well, excellent stuff. Thanks for those responses. There were a few other questions that we're going to route to our experts, and we'll be responding to those via email. I want to thank Oxford Economics' Ryan Sweet, who you all know we used to work with at Moody's Analytics. It's a small world. He is now chief economist over at Oxford, and we're very happy to be working with him again. You can find all of that information over on oxfordeconomics.com, of course. And if you would like more information on what business information is up to, you can find us at experian.com/B2B. Please, if you could let us know how we did when you exit the webinar, it really does help us improve upon and keep making these webinars better. We really appreciate your feedback with just a few short answers to that short survey. Until next time, everyone take care, have a great holiday season, and have a great day.